Friends, welcome to another video in our series Finance and Investing Tidbits. In this video, I just want to highlight a few corporate governance issues that you need to be aware of in your own journey of equity investing. That helps us to create appropriate defenses once we are aware. At least we are able to watch or keep an eye on what could be the vulnerability of our own investments in respect of these corporate governance issues, so that you can devise your own strategy, you can create your own defensive mechanisms around it. And of course, I have explained why I follow defensive investing strategy, particularly investing through holding and investment companies. So I'm sure you will find value in exploring those. I'll also provide links in the description box. Welcome to this video. First and foremost is the lack of independence of the so-called independent directors. Let us remember that their appointment is also largely influenced by the promoters or executive board members who are involved in the business. Thus, we need to take the independence of these independent directors with a pinch of salt. This issue has become very complicated because of very high compensation which is offered to these independent directors, and they also get compensation which is linked to a percentage of profits. It's not obviously given to each director, but that is used as a pool for compensating all the independent directors together. So when there is such a high financial stake of an independent director, there is also a risk that they may compromise in their independence, including supporting extremely high compensation to executive directors. So where they themselves have been rewarded very handsomely for a very, very limited time in a year that they are investing for the company, they cannot say no to an obscene compensation being paid to executive directors. So this becomes you scratch my back and I scratch your back. And that is something where we as retail investors, have a bit of an exposure. Now, of course, in the context of a largeness of a company, the overall compensation may not be so staggeringly high. But at the same time, there is this risk that compensation may be paid which is much beyond the market or the real contribution of the people at the senior helm. Because quite often what happens is that a lot of contribution is made by people in the ranks below, but there is a huge gap between the compensation given to these people who are on the board and the next layer or layers, which may not be very fair. So this larger than life view of directors themselves is not something quite often fair. Rather, they should ensure that their own colleagues are well compensated, rather than it getting into winner takes all kind of an approach. And this is where the independent directors may not be able to really exercise the independence, because they themselves are being paid very, very handsomely and quite often disproportionately for their time and effort. The other issue is related party transactions, and this particular issue becomes very important when the promoters have a very small stake, say less than 25% in a company. So the incentive to get into related party transactions, which may not be, very, very fair to the investors of the listed company, can arise. For example, the promoters, when it comes to owning properties, they may not own the properties in the name of the listed company. The promoters may tend to own the properties in their privately held companies, and then the listed entities take them on lease from these privately held companies. So the property appreciation goes to the promoters, and there is also a secure business model which is created for those privately held companies, because they are going to get rent from these publicly listed companies which belong to the same promoter family. Now, this risk of related party transactions is high when the promoter stake is low. If the promoter stake is also very high, the incentive to get into these related party transactions is not much. Also, another way related party transactions can happen is that they may route business through their privately owned companies pocketing some of the profits which are due to the shareholders of a publicly listed company. So instead of invoicing directly to the ultimate customers, they may invoice to a related party which is privately held by the promoters, which in turn invoices the final customer, and it is able to make a neat profit without really making a value addition, except that the profits are routed through another entity. Now that may not be very fair to the shareholders of a publicly listed company. One other problem with so-called professional managed companies is that there is a tendency of self-perpetuation. They want to occupy executive positions even well past 70, right? It reflects badly on their inability to create future leaders, trying to pocket all the gains themselves. So that's not something which is very fair and good for the long term of the organization, because the success of the senior leadership is to continually create new leaders in the organization and give way to them rather than continuing to occupy those positions themselves. So this is again a problem. This is not so much of a problem in promoter driven companies, because they want to put the skin in the game. They have a massive stake in that company. So to that extent it's fine. But for professionally managed companies where the executives are owning a fraction of the company's shares, why should they have perpetuity there? They should rather give way to new managers, and who may be able to make a better contribution. And also with age, their ability to make meaningful contribution also gets restricted. But that is something which is quite often, not given the due attention, and we need to be aware about it. Now, all mutual funds tell us that no one can time the market, and hence we should always do SIP. Of course, I don't agree with it. I have already created a video on SIP myths and reality, but I'm just saying the propaganda which goes on. Now, this is quite interesting that while mutual funds make this claim, company managements have a knack of issuing stock options at a time when they would never issue share capital to any other investor like private equity, or they will never come out with a rights issue. But stock options has a different logic, because that's where the personal benefit to the executive directors and key employees is going to come in. And typically we find that the stock options would get issued when the market is extremely weak. That means the market has fallen. So therefore the stock option can be issued at very attractive prices to the employees. So when these stock options are issued when the prices have collapsed in the market, imagine the COVID times, or even any other periods when the markets are very weak, the employees will pocket massive gains when the prices recover, but they have been given stock options at very low price. I know of an example of a company which is a very respected company, which is an NBFC, which issued stock options to its own executive directors and the chairman at a time when there was a collapse in the markets due to Lehman Brothers crisis. So at that time, when the prices had corrected by 60% from the peak of January 2008, they merely issued stock options. And even there was a conflict of interest at that time, because the compensation committee chairman himself got stock options allotted to him. So there was a direct conflict of interest. The chairman should have taken care of the interest of the wide body of shareholders. There was going to be a dilution in the EPS, but all that was disregarded. Of course, the names involved were very big, so naturally, nobody kind of asked them questions. But of course, Company Law Board came out with this diktat at that time that the compensation committee chairman should not get stock options. And now thankfully in the new Companies Act 2013, this is just not allowed to the non-executive directors, to avoid this conflict of interest. So that is at least good, but historically those kinds of advantages have been taken. Also, sometimes the promoters get into unrelated diversifications. Now that has nothing to do directly with the shareholders of this company, but what happens is that these promoters pledge their shares. Now, if the unrelated businesses fail, it could have a spillover effect on the prices of the original company, because those pledged shares may be priced for a sale. Now that has an impact on the sentiment and it brings down the prices, and unnecessarily for that unrelated diversification the shareholders of the original company would suffer. Another thing which also is something that we have to be very careful is the ambitious acquisitions driven by egos of corporate leaders. And typically they happen when the economies are booming, and that too is done out of borrowings. Do see my video on the impact of operating and financial leverages, and I have created that video in terms of the care that investors have to take because of this. So that's something you can definitely explore on my channel. I'll also provide a link in the description box. Now, by doing these actions, they risk creating a major accident when the economy turns down, and because they are financed out of borrowings, there are the interest costs meter is ticking, and then it can create a major challenge, and there could be a tremendous fall in the prices of these shares. Also, another observation is that the board members, particularly independent directors, may be luminaries in their own fields, so they are very widely known names, etc. But that does not mean that they have experience in this specific business. Also, they don't have sufficient time to understand the nuances of the business, and therefore, while they may be very eminent in their own domains, their ability to contribute meaningfully to a company's well-being could be very restricted. So this is something we need to keep in mind. One other problem that we need to keep in mind is that the executive directors, people who are actually involved in running the business, may get into a very short-termish kind of approach to the business, purely because they are required to show improvement every quarter because of this requirement of quarterly results. Now this also creates a pressure on them, and quite often decisions are taken which may not be very good in the long term. So this is also another corporate governance issue that we need to be aware of, and unless the independent directors are able to put their weight and ensure that short-termism does not creep in, there could be challenges and problems that can arise. So this is also something very, very important. For more such videos, do explore our channel, Dr. Abhijit Fadnis. Thank you.